Hello and welcome back. Under the basic terms section of this course, we are going to be looking at the following, some of which we have mentioned earlier in the introduction and some were not mentioned. However, we'll continue from here. Now, a currency, every country's currency is represented with a 3-digit code, which represents the name of the country where the currency is used and the currency itself. So it comes from an acronym. For example, you have GBP representing Great Britain pound, and US representing United States dollar, Euro, EUR for euro, JPY for Japanese yen, JP for Japan there. So the first two letters represent the name of the country, while the last letter, the third letter, represents the currency. So JP for Japan, Y for yen, AU for Australia, D for dollar, that's Australian dollar, NZD, NZ for New Zealand, and D for the dollar. Okay, now currency symbol or pair. The currency pair is when you pick two currencies and bring them together to form one symbol, one instrument. That's when you have a currency pair or currency symbol. An example, or some examples you have there include GBP USD for a symbol or currency pair, Euro USD pair for another symbol, USD JPY pair for another symbol. Now, base currency, in the currencies quoted there, in the currency pairs quoted there, you have one on the left side and you have another on the right side. The one on the left side, in the case of GBP USD, is the base currency, while the one on the right side, the USD, is the counter currency. Alright, now the base currency is the one on the left side and its value is 1. The value of the GBP USD, the GBP here is 1, while the counter currency is the one on the right side and its value is variable. That means you pick this from the bid and ask. We'll be looking at bid and ask later on. Now, the price or the value of the US dollar in GBP USD is not fixed. It can be anything. For instance, you have a currency quote here, GBP USD, giving you 1.5550 slash 1.5553. All right, the price you see here is the value of the US dollar, while the GBP USD has value of 1. Here it's telling you that 1 GBP is going for about $1.5550 or $1.5553, depending on what you want to do, buy or sell. PIP, PIP, that's the acronym, means or represents the price interest point. It represents price interest point. It's a basic unit in forex trading that is used to measure the change in value in a currency pair. It usually is the equivalent of 1/100th of 1%, 1/100th of 1%, but it depends on how many decimal places a currency pair is actually quoted to. For example, a pip is always the smallest amount by which the currency's moves are measured. For instance, you have GBP USD here at 1.5550. The least movement will be from 0 here and 3. So 0 and 3 here will be representing the pip, which will be the least movement, the smallest amount. Okay, so if 3 moves to 4 and 0 moves to 1, that means he has made a 1 pip upward move. If 3 drops to 2 or to, let's say 3 drops to 0, and this one now will drop by 3 points, making this one to become 4 and this one becoming 7, then that would be 3 pips drop. Okay. Another term you need to know is leverage. Leverage is the use of credit or borrowed funds to improve your speculative capacity and increase the rate of return from an investment. For example, buying securities on margin. Now it's like a loan. Leverage is like a loan. You have $100 and you are asked to choose a leverage. That means that leverage will be serving like a multiplier for that your 100. Assuming you choose 1 to 100 leverage, that means that your $100 will be multiplied by 100 times when you place an order. Okay. Then margin is the amount of money that you are required to deposit in a trading account to open a position or to maintain an existing position. That's your margin. It's similar to money, you put down to secure a loan. So in this case, the loan here is the leverage, while the margin is the collateral. All right. Then lot size, it is the unit for measuring financial security contracts. Lot size, I'll be dealing with it a little more to break it down. There are different lot sizes you need to know. I'll be dealing with it in a subsequent video. All right. Bid price is the lower quote price at which a currency can be sold and the market is willing to pay. For example, that's the price you will be selling and the market is willing to pay you. The market tells you this is how much I want to pay, and then you choose whether you want to sell it at that price or not. That's for bid. Then ask is the price which is higher, a quote price at which a currency can be bought and the market is willing to sell. Okay, for instance, what we had here in GBP/USD, this one here, which is lower price, you know that 1.550 is lower than 1.553. So the lower price value here is the bid, which the market is saying I want to pay, while the higher price is the ask price, which the market is saying I want you to pay. So you either accept or reject it. Spread, while the spread is the difference. Spread is the difference between the ask and the bid price in pips. For instance, you have 1.5550 for the bid here, while the 1.5553 is the ask price. So the difference between these 3 and 0 is the spread. Even if you just subtract this entire value, you have your 1.5553 minus 1.5550, you have 0.0003. So that 3 is now equated to a whole number, giving you a spread of 3. Bullish, when you say that, first and foremost, a bull is a trader who has taken a buy position because he expects that price will be on the rise. Therefore, a bullish position is a position characterized by rising prices, while a bear is a trader who has taken a sell position because he expects that price is going to fall or go down. So bearish position is a position characterized by falling. A bearish position is a position characterized by falling prices. So when you say that the market is bearish, you mean that the market is characterized by falling prices, and when it's bullish, it's characterized by rising prices. While a long position is a position taken for buying securities, and short position is that which is taken for selling. Take profit order is an order that is automatically set to close a trade for profit when it reaches a particular threshold. For instance, you buy, you're in anticipation that price is going to rise, and instead of price getting to a particular target and turning back, you would have calculated how far you want to take it, and once it gets there, automatically it triggers and closes and keeps your profit. While a stop loss order is an order that automatically closes a trade when it has reached a certain negative limit. Now you use it to detach your emotions from trading losses. So when you are placing a trade, it's important that you also determine how far can I allow this to get to before I exit if it goes against me. So you set up that as a stop loss order. While spike is just any move in the market that is not normal, that is larger than normal movements in a currency price. Particularly, these spikes happen mainly when there are economic or fundamental events. Okay, so just pick up the next video. Thank you and God bless you, and see you at the top.